Right, words I don't often say. Here's what we've all been waiting for, the accountant. John Holliday.
Hello, let me get this thing working. Yes, I'm John Holliday and I'm from a company called Pocknells. We're a firm of chartered accountants based in Southern Ferrers. I'm a partner there, but I'm also a residential and a commercial landlord, so I'm also going through this personally, so it's affecting me as well. So just bear that in mind when we're going through these slides and you're all thinking, sorry, I'm in the same boat. So just a quick disclaimer. Obviously these slides are only meant to be sort of guidelines. You can't sue me for them basically. Come and get some proper advice if you want to talk about it in more detail. So yeah, basically the headlines in the newspapers over the last few years have all been very negative. Last few months have all been very negative towards buy-to-lets. With all the recent changes, there's a lot of press about this, obviously. So the buy-to-let mortgages have cut. Santander requires rent increases to get mortgages. I think landlords are finding it harder and harder to get the mortgages they require. 60% are affected by the changes, and 10% did not know. So, and the Guardian said that the mortgage tax relief cut doesn't add up for buy-to-let landlords, and it definitely doesn't in some circumstances. But it's not all doom and gloom. I think the thing we've got to bear in mind that property is a very good investment. The property prices have steadily increased year on year, 25.68% over the last 5 years, and the property rent has risen steadily year on year. Apparently it's risen by 5.1% outside of London, 7.7% in London. That was 12 months up to April 16. So there's still a good investment. Unfortunately, the tax breaks aren't quite as good at the minute. So the recent tax changes, accounting changes that have come into effect. Unfortunately, there's no more wear and tear allowance. This is going to be replaced by a new replacement relief. You're now able to prepare accounts on a cash basis, which means you don't need to worry about accruals and prepayments. The rent received will effectively be treated as income. This is going to cause a lot of problems, and we come on to this in a minute. There's also something called quarterly digital reporting, making tax digital, which comes into effect from April 18. Again, this is something that could be a real problem for landlords, and we'll discuss that in more detail in a minute. And the main thing, mortgage interest and mortgage finance fees are no longer going to be an allowable expense. They're going to be treated as a tax reducer. And this is going to be phased in from April 17, so from now. You've also got the increased stamp duty, which obviously everyone's probably aware of. It's come in last April. And we've got the reduced rates of capital gains tax. But unfortunately, these do not include residential properties. They're still at 18 and 28%, so you're still going to have those tax charges on the capital gains. So on to the replacement relief. The wear and tear allowance, it used to be 10% of your rent if you were renting a furnished property. That's gone now. It's no longer there. It actually went last April. Now it's all about you actually replace, sorry, I'll move away from that, about you actually replacing your items. So when you replace an item, you're allowed to claim for it, but you're not going to be able to do just a 10% of turnover of your rent charge. This mic's annoying. It's available on furnished and unfurnished rental properties, but it's not for furnished holiday lets. There's still claim wear and tear if they want, and it's not available for commercial properties. The expenditure must relate to the replacement of a domestic item used solely by the tenants in that property, and the old item must no longer be available. It must be capital in nature and wholly for the purpose of that business. And the renter room relief can't have been claimed for it to count. Yeah, basically the toilets, the baths, the sinks, they're still going to be treated as repairs. You're not going to have any problems with those. So the thing that I was getting onto with all this is you really need a clear inventory. When your tenant goes in, you need to have a clear inventory. HMRC are going to be challenging landlords to say, where's your inventory from the start? We want to see it because we want to see it for the replacement relief. So it's going to be something that landlords have never had to worry about before. In the coming years, it is going to be something that's going to come to light. Also, the last one, it has got to be a like-for-like expenditure. You can't replace IKEA furniture with Harrods furniture. You can't buy a washer and replace it with a washer-dryer. It's just not, they're not going to accept it. You're also able to now prepare your accounts on a cash basis. This draft legislation has been put in place for 17-18, And to be honest with you, it doesn't really affect much for landlords. Most landlords would have always prepared them under a cash basis anyway. It's a default way of preparing them. The maximum threshold for this is 150,000, so if your turnover is more than 150, you're going to have to do the accruals basis, which again, this is all accountancy jargon, which I'm sure is something that other people would worry about. Cash basis is the default option, so you've got to opt in or make an election to get out of it. And landlords with multiple property businesses, including overseas properties, the entry threshold and decision to opt out is on each property. It's not on the whole property portfolio. You can decide on each split. And yeah, if you've got trading income, again, that doesn't affect your property income. So if you've got a business alongside your property, that doesn't affect it. So then we get on to the major changes, and this is probably where it actually gets a bit interesting, this talk. The mortgage interest and other financial costs are no longer a tax allowable expense. So from 6th of April this year, they're now a tax reducer, and this is done at a basic rate. So what does that mean? Effectively, the main issues are going to be that landlords are now going to find that they're falling into a higher tax bracket. They're also going to find that it's costing more to have these properties unless they're a basic rate taxpayer. And because of the changes, they might no longer be a basic rate taxpayer, and we'll go on to that in a minute. Finally, some of the people who are employed and earning quite a lot of money could be losing their personal allowance thanks to their buy-to-let property portfolios. Again, this is all a bit of a concern. And also, people who are sort of on the 50,000 mark or just under at the moment, thanks to their rental properties, could be losing their child benefits if they were receiving them. So again, this is something that landlords need to be aware of. Yeah, the other thing I sit on here is everyone needs to note when we're going through these cases that the interest rates at the minute are very low and are probably only going to go up. They're probably not going to stay at this level forever. Hopefully they do, but I'm sure they won't. So it's something that you need to bear in mind. So how are these changes coming in? They're going to be tapered over the next 4 years, and this is the taper charge here. So in 16-17 they were 100% deductible. This year they're only 75, so 25% of it will be coming on a tax reducer. It goes down to 2021 when it's completely gone. So that's what you have to bear in mind. So let's look at some examples, and I'll show you the outcome of how the tax and these changes are actually affecting things. So example 1, Mrs. Smith is an individual with employed income of 35,000 and rental income from a residential property of 20,000 a year. Her mortgage interest is 10,000 and her other expenses are 2. So as you can see there is 16, I don't even know how to use the point on it, here you go. In 16-17, her net taxable income was 41,000 and her tax liability would have been 6,000 on in these earnings. In 2021, her taxable income would be 53,000 and a tax bill at 8,400. So she's going to be £2,400 worse off on the current tax rates with the current personal allowances if she had the same properties, and that's in 4 years' time. Obviously, as I say, it's going to be tapered over. The main problem with this one, if I can get this to work, is now her income is over the 50,000, and if she was in receipt of child benefit, she would also be paying that back, which is another charge that she wasn't probably expecting, which people need to be aware of. Basically, this property income is now being treated as income, where before it was getting the expenses taken off of it. It's not anymore. It's coming down here on the bottom as a tax reducer, and that's what the problem is, and that's what's going to be causing a lot of landlords a lot of problems. Example 2, Mrs. Smith is an individual with employed income of 85,000 and has 6 rental properties that she owns with her husband and splits 50-50. Her share of the income from the residential properties is 40,000 a year, and her mortgage interest is 25,000 with expenses of 8. So in this example here, you can see that before 16-17, her tax bill was 26,000. In 2021, her tax bill was 34,400. So her effective rate of tax is 37 instead of 28. Now the main problem here is where her income before was at 92, this year it's at 117. And because she's gone over the personal allowance, it's reducing her the 100,000, it's reducing her personal allowance by 8,500. Yeah, 8.5, spot the accountant. Reducing it by 8,500, and as such her tax bill's going up. So again, this is something that's going to be affecting people who've got a lot of investment properties or are earning high salaries or high self-employed income. Yeah, so she's over the 100,000 and losing her personal allowance. Example 3, this is where it really hurts, and I don't know if anyone in the room has got this. A portfolio business. So if you have a portfolio business as your main occupation, so let's use this as an example, Mr. Jones, He has annual rents of 600,000. He has interest costs of 250 and running costs of 50. So at the moment he's making £300,000 a year, which he pays the tax on. The tax due in 1617 would be 121,100. You can see it going up each year where this taper relief's coming in. By 2021, he's paying £233,600 in tax. That's 77.87% of his income he's paying in tax. It was only 40 before. I mean, obviously he's still making quite a lot of money, but it's a bad tax bill. With his £600,000 worth of income, once you take off the expenses and the running costs of 300,000 and the tax bill of 233,600, his take-home pay will only be £66,400. Bearing in mind interest rates are low and he could be on a repayment mortgage, he could actually be running at a cash flow deficit here. It might not actually be profitable for him to have those properties anymore. But it's not all doom and gloom. So if we look at it from Mr. Jones' point of view, if he moved his buy-to-let portfolio into a limited company, the tax has been, yes, this calculation has been done exactly the same way as the other one. It's been done on the fact that he's distributed all of his income through dividends. We haven't left a penny in the company. So his tax bill then for 1617 would only be 131,135, and by 2021 it's actually 132,421. Compare that to what his tax due is here, and you can see the savings. By 2021, Mr. Jones is saving over £100,000 a year by being in a limited company instead of being in his name or his wife's name or joint names or whatever he's in. So it's something that everyone needs to consider, especially large portfolio holders. And I said on here, furthermore, we've assumed that all the profits are distributed. Now, with a limited company, you do not have to distribute the whole lot of profits. You can keep some in the company. The corporation tax charge on that example is only £60,000. There's a lot of profits there that he doesn't need to distribute. If he didn't need the money, he could leave it in the company, pay the £60,000 tax charge, and actually his tax bill could be a lot lower than what it is. He could also look to split the shares amongst family members, which again could reduce his tax bill. Or he could pay wages to family members who undertook work for the company. Or make personal pension contributions or company pension contributions through his company to again reduce his tax bill further. So there's a few options here that Mr. I forgot his name now, Jones I think it was, has available to him. So should you look to move your properties into a limited company? Yeah, this is not a straightforward answer. And the problem is, it really depends on your own portfolio. Everyone sitting around here who's got a portfolio of properties is going to have a different answer to this question, and it all depends on your personal earnings, how much interest, how much borrowing you've got on those properties. It's not going to be straightforward. The main thing I would say is get some professional advice. Go and chat to your advisors and make sure you do it soon, because as you can see in 4 years' time it's really going to bite, and 4 years comes around pretty quick, to be honest with you, and if you're going to move things around you need to do it sooner rather than later. There's always going to be advantages and disadvantages for holding properties for a company, and we can look at these in a minute. But like I said, they're landlords with large property portfolios, higher rate taxpayers. They really need to go and see their accountants or see some professional advice and get it sorted. It's not going to be straightforward. Any properties moved are potentially going to have capital gains tax issues. Again, going into a bit of accountancy talk, if you like, there is a relief called a Section 162 claim, which you can make on incorporation. And the rules are it's got to be an ongoing business, it's got to be transferred as a going concern, and all of your properties in your personal name have to be transferred into that limited company. So if you were looking to do it, you might qualify for this relief. If you were going to do it, you probably need to have at least 6 properties in your personal name. You probably can't do it if you've got less than 6, because they would say it's not a property business, it's just a hobby landlord is what the HMRC would class it as. You wouldn't be qualifying for the relief. You probably need to be doing more than just sitting at home collecting the rent as well, because to be honest with you, they would say that's just a hobby landlord. That's not what they see it as, a genuine business. It's got to be run as a genuine business. Like I said there, it would be very sensible to ask HMRC for clearance before you did this transaction and found that you had a huge capital gains tax charge off the back of it. There would still be stamp duty issues. So again, this is where you need to sit down with advisors and you need to work out whether the stamp duty issues, the capital gains tax charge is going to be worth the saving in the long run. Like I say, moving it all depends on the individual circumstances. The way I would look at it personally, if I was talking to someone in the break, is I personally probably wouldn't like I say, I've got a couple of properties. I probably wouldn't move them into a limited company now, personally, because I haven't got a big enough holding to. But probably future properties I would look to buy for a limited company, or at least consider it. You're going to have the stamp duty charge anyway. The mortgage interests are slightly higher at the minute, the fees are slightly higher, but in all honesty, they're coming down. There's more and more lenders who are doing buy-to-let mortgages through limited companies, and the more popular it gets, the more lenders are going to come to the market and offer the services we want. The other thing I've put on there is if you have a separate trading business, this is quite a neat little trick that accountants use. If you have a separate trading business, you could consider setting up if it's a limited company, you could set up a holding company above it, and that could lend money to your property portfolio business. So one of the ways that you do it, I'll go on here, is the trading company, what have I done? Wrong button, sorry. The trading company pays dividends tax-free to the holding company. It gets it out of the trading company's name. It means it's safe from creditors or anyone who could attack it. The holding company then lends the money on a commercial loan to the property company, and the reason it would do that is because you could hold the property company in separate names to your business names. So you could have husband and wife here and 2 business partners here. They lend the money across. Yeah, and just minimising your tax bill. So it's something worth considering. Advantages of a limited company. Yeah, the mortgage interest and finance costs are currently fully claimable, exactly the same as they were for us before. Now it's only for limited companies that you can claim those finance costs, you get full relief on them. There's a lot of IHT planning you can do around a limited company. One of the great things about properties in limited companies is there's obviously landlords who've got a lot of properties have an IHT problem. At some point in time, unfortunately, we're all probably going to die. And when we die, we're going to leave these nice little nest egg of properties to our children or our families or whoever it is, and they're probably going to be over the IHT threshold. And we're probably going to end up paying 40% on most of them. So a company gives you a few options that holding them in your own name doesn't. For example, one of the things you can do is you can set up trusts, which lend the company the money as deposits, go out and buy the properties. As long as you put the money in that trust for sort of 7 years before you die, it's out of your estate, blah, blah, blah. So again, this gets it out of your estate and potentially gets some money out of your estate so you won't have to pay IHT on it. The other thing you can do is you can set up a company with preference shares, so you could have parents holding the preference shares, children holding the actual ordinary shares. Again, the preference shares hardly have any value. So again, you're basically nullifying or reducing your tax burden on death, which again is something worth considering and something that all landlords will probably have a problem with one day. The other thing that's great about a company is it's very easy to change the ownership of a company. Change ownership of a company. Unlike a property where you have to go and see the solicitors, you have to pay the stamp duty at quite a high rate, etc., etc. With a company, an accountant can do it in about 5 minutes. Well, probably a bit longer. They'll charge you for longer. But it's not a tricky transaction. You can get it done pretty quickly. It's only 0.5% stamp duty on the transaction as well. So it's much cheaper than transferring properties between each other. The other thing that a company does, which we touched on earlier, is it allows you not to distribute all of the profits. So Mr. Jones, who had his 200,000, could distribute 60,000 if he wanted, or 40,000, and keep himself in that tax band that he wants to be in, the lowest one, where he's only paying 7.5% on the dividends he's receiving, and not 37.5%. So again, this is something that people could consider and look to use in the future. The other thing it can do, which we mentioned earlier again, is it can pay wages to people undertaking work. So again, it's a way of getting some money out, maybe making your state pension contributions if you're not, your NIC state pension contributions. And low rates of corporation tax. At the moment, they're 19%. They're supposed to be going down. Whether they do, I don't know. But they say they're going to bring them down and make us the most competitive corporation country in the world for corporation tax. Whether they do, I don't know. So disadvantages of a limited company, it can't all be good. The mortgage interest rates and fees are slightly higher at the minute. You are going to have to pay a little bit more to have these products, but your tax savings could be vast. You have double taxation on capital gains tax. That's probably the biggest problem at the moment with limited companies. A lot of limited companies, when you sell them at the moment, you're able to claim things like principal private residence relief if you ever lived in the property before you sold it. It's a good relief. You're also allowed to claim things. I thought there's another one you're allowed to claim, but I don't know, it hasn't popped up. So you're allowed to claim these things to reduce your tax currently. You've got 2 personal chargeable capital gains tax allowances, annual allowances, which you're allowed to use if you've got husband and wife who own properties. With a limited company, you won't have that. So again, you're going to have a slightly larger charge on exit. But some people don't want to exit. Some people want to leave them for their families to pass down for many years. And maybe it's not a problem. Larger legal fees, yeah, you are going to probably have larger legal fees. There's more administration that goes with them. You're going to have larger lending fees, probably slightly larger accountancy fees. Everything's going to be slightly larger. But if your tax bills are a lot lower, you might not mind. Other ways to minimise your tax bill. Make sure you're claiming the correct expenditure. I mean, that's key. The amount of clients that come in and they're not claiming for things like the lease renewal or whatever it is, the fees on the mortgage renewal. You need to make sure you're claiming the right expenditure. Pension contributions. I think these are going to become quite important, really, with the new bandings, the way that the property income is being treated. Pension contributions could keep you in the right tax band. I know you're locking your money up, but for people who are losing their personal allowance by 10,000, it'd be much sensibler to pay 10,000 into a pension pot than it would to be paying sort of 67% of it into the taxman's pocket, if you like. Again, that shouldn't be on film. Introducing your partner to the properties. Yeah, there's no capital gains tax for spouses, into spouses. So if your wife or your husband aren't on your property and they're a lower rate taxpayer, it might be something that's worth considering, bringing them in. The other thing on that is it's also very important to, when you sell that property, make sure you bring them in. Because if they haven't got any capital gains tax disposals in that year, they've got an allowance that you're not using. And you only need to bring them in 5 minutes before you sell the property, which your solicitor can do for you easily. Transferring properties into children's names. Again, this could give rise to a tax charge, and there could be stamp duty issues, but there could be other benefits here, IHT, etc., which is an expensive tax if you're lucky enough to pay it. The other issues that are coming along, so making tax digital. This is something I don't think landlords are really aware of. At the moment, they're saying that anyone who's over the VAT threshold, which is only 83,000, will be liable for quarterly reporting on the Making Tax Digital. It comes into effect from next year, so next April. But if you have 4 or 5 properties, there's a good chance you could be, well, maybe a few more, but you could be getting close to that if you've got them in the right areas. And you might have to be doing quarterly accounts, which I suspect most people wouldn't even consider. The increased stamp duty, we mentioned this. Obviously, everyone's probably aware of it. The 3% came in last year, so you've got increased stamp duty on the residential properties. The only thing which a lot of people are forgetting is if you sell your main home and go and buy another property, you have to pay that 3% stamp duty again if you keep your main home. You couldn't sell it for whatever reason if you're lucky enough to go and buy another one. If you sell that original home within the 3 years, you can claim back that extra 3% stamp duty that you paid. So you need to remember this, and you need to make sure your solicitors remember this because they often forget. So it's a simple form, and it could be a lot of money. We did one for our client the other day, and it was sort of £25,000 he got back from just remembering to actually claim it. Yeah, the other thing that's quite interesting is the increased stamp duty does not apply to commercial properties. It also doesn't apply to mixed properties. So if you had a shop with flats above it, it wouldn't apply. It's classed as a commercial property. A lot of landlords are using that as an excuse to buy these sorts of properties, renting the shop out and renting the flats out above. Again, it's something that's worth considering if you are looking to invest at the moment, sort of thing. Another thing to be careful of, I don't know if anyone does own own properties through their limited company, is this thing called ATED reporting, which is envelope tax on dwellings reporting. The value is 500,000. So if you own a property in a company that's over £500,000, you have to now report this to HMRC. The valuation was done at April 2012, so it would have to be quite a substantial property. The problem is they're going to revalue every 5 years, so the next valuation is at April 17. So if at April 17 you own a property through a limited company that's over £500,000, next year you've got to report it. It's only a form, but it needs to go in, and there's penalties if it doesn't go in by the 30th of April next year, so 30th of April 18, 30th of April 17 if you've got any this year. If you're renting it out, there's no tax charge. It's just literally a form to complete, so you just need to be aware of it and make sure that if this applies to you, you get your accountants to do it for you. The other thing we've got is the reduced rates of capital gains tax do not apply to the residential properties, which we mentioned earlier. They only apply to commercial properties and the they apply to the commercial properties and the furnished holiday lettings. Again, do not forget about the interspouse transactions, no gain, no loss. So we've mentioned that. Yeah, in summary, it's key to get professional advice before you undertake any transactions. The amount of clients who come in and see me, I probably shouldn't say this, and then say I've bought some properties or I'm in the process of buying properties, and they haven't gone through it all. So we need to make sure you've spoken to your accountants beforehand. you shouldn't take advice from your friends or people down the pub, which a lot of people do. And it's normally the best advice ever, but it's not correct. So that's the problem you have. They do know how to not pay any tax, but it's definitely not correct. And also, no landlord's in the same situation. Even if you had the same property, you're probably not going to be earning the same employed earnings or the same self-employed earnings. So there's not going to be many landlords in exactly the same situation. A little plug. When we offer a free initial consultation, we're always happy to chat. We've been established 35 years. Been helping businesses and landlords for a long time now. We offer out-of-hour appointments, fixed fee solutions and unlimited support. So if anyone needs a hand, give us a call and we'd love to talk to you and look at your situation individually. And that's it really. So thank you very much. Thank you.